right. Great. Hold on just a second. I like to record it from my end as well. So we are live on YouTube. Hello, everyone. Okay, great. Just let me 1 second. And this is my recording. All right. Good afternoon, everyone. Thank you for attending the Mr. Top Step open house this week. And hello to everybody out on YouTube. This is my first YouTube broadcast, so hopefully it goes well. Today's presentation is going to be on the opening range breakout strategy that we have here at Polaris Trading Group. And this is not a theoretical presentation. It is a practical presentation. We will show you what we do on a each morning basis. We'll actually show a couple of the live recent trades we've taken in our room with everybody present. And so before we proceed, again, of course, industry regulations, you've seen these disclaimers already in the past, but industry regulations do require us to show that and state that hypothetical performance results that you may see have inherent limitations. And of course, past performance is not necessarily a future indicative of future results. All right, and Polaris Trader Group does offer services and products for educational purposes only on a subscription basis. All right, so that said, let's move ahead. I'll give you a little background for those that do not know who I am and how long I've been in the business. I've been actually in the business now 36 years. I just recalculated that the other day. I started in 1983. And I worked for a number of different concerns over the years, but in my more formidable trading years, I worked for the investment banks and a few hedge funds, Shearson Lehman Brothers years back, as well as United Bank of Switzerland, and again, a number of high-frequency hedge funds when I left UBS. During my tenure at those companies, I was a market maker in listed and NASDAQ stocks. I also traded index futures and derivatives. And as a trader, portfolio risk management was an everyday affair. Currently, I'm also registered with the NFA as an associated person, and I do run a commodity trading advisor service. All right, so I am fully registered with the NFA, and which requires that we follow all the rules and regulations as such. Just to give you a quick overview before we get to the main presentation of our mission here at Polaris Trading Group and some of the benefits our traders receive. And it's really kind of a four-pronged approach. All right, we kind of keep them really simple and direct. One, and the four prongs that you see are not necessarily in order of sequence, but all are beneficial. We want to improve the trader's decision-making skills. That is a primary concern of ours. A lot of folks have a difficulty of formulating. There's a lot of information out there, and kind of formulating what to do, how to do it. All right, and we kind of give everybody somewhat of a step-by-step approach as we see it. Many traders have bad habits. We want to change those for you guys. So we help you learn some new empowering trading habits there. Demystify market action. All right. Again, lots of people are confused with what happens today, particularly with all the algorithms that are out there today and so forth. And it seems as though day to day, they just simply at the end of the day scratch their heads. What was that move about? What was this move about? And so forth. And there's a lot of confusion out there. So we try to, dig down and try to strip away all the, the BS. All right, and try to, kind of keep things simple. Again, we don't want to complicate things. All right, and that just confuses, our brains. And so we want to try to kind of demystify what's happening and break it down into the simplest form. So, and then we want to become our traders to become more informed. All right, and so people categorize traders, today as retail or professional or so forth. I simply categorize everybody as either being informed or uninformed. And that means the level of knowledge that you have. All right. And the more knowledge that you have, the more good knowledge that you have, all right, the better, at least hopefully, the correlation will be that you'll become a much better trader, more informed trader, and not, being one of those folks that are sitting there scratching their heads. All right. So again, the market is very multidimensional, and we want to kind of sift through all uh, the chaff and get to the wheat, so to speak. All right. So let's get to our presentation today. I'm going to give you just a slight background, of how we see the opening range. Now, there are a lot of folks out there that do trade the opening range. There's a number of different approaches to trade the opening range, and I'm sure each one of them has their merits. And so, as such, you know, um, they whoever's employing those, and as long as they have some sort of backup statistics and so forth. But the opening range has been around for a long, long time. We use a 3 and 5 minute parameter on the NQ and the S&P. There are also 15-minute opening ranges, and I think another popular one is a 30-minute between 9:30 and 10 a.m. All right, but we use a 3 and 5 minute. Okay, and so why is it important to a day trader? Right. So today's with the 24-hour markets. All right, around the world as they go from U.S. to Nikkei to Shanghai to Europe, back to the U.S. But here in the U.S., we still have our 6 primary trading hours. Okay, and as such, the main mutual funds, all the big money traders, particularly trade the domestic, market. So as such, the 9:30 opening is still, a very important opening. Now, during the off trading time, all right, of RTH, regular trading hours, and over the weekend, again, all the analysts, economic announcements, portfolio managers, everything worldwide events, global, events have an effect on investor sentiment and decisions on what they want to do, how they're going to adjust their portfolios to the current events or what they foresee, in the near future, right, as a result of some of the current events and so forth. So all those decisions, everything there, uh, on a day-to-day basis kind of gets pent up, and it kind of explodes on the opening. So the opening strategy is still one of the real best strategies, that we found out there, that offers an opportunity to get an explosive move early. It is a momentum move, and that's why we want to trade it as such. And so it carries a lot of weight with traders. Okay, so that's the importance of it as we see it. A little bit of the background in this particular top part of the slide where it says the opening range principle has been researched extensively. Now, not my research. I took a source, this particular quote here, where it says that the opening price will be near the high or low of the day 85 to 90% of the time. All right. In other words, the opening price essentially is within 10% of either the high or low for that day. Now, where did I get that? All right. Does anybody know Larry Pesavento? All right. He's been around for a long, long time. He wrote a book, I think co-authored as well, Fibonacci Ratios and Pattern Recognition. You can find that page 109. He did a lot of research with another gentleman. His name I forget at the moment, but did a lot of research on the opening. He did his own research. So these are the results of his own research, and he offered them up in his particular book that was published back in 1997, and pretty much that has held, as far as I can uh, tell, fairly well those statistics. So what does that all mean to us? If you think about that, the opening price is near to the high or low of the day, 80 to 95% of the time. I think that's a significant statistic to have, knowing that that you could be within roughly 10% of the high low of that day's range, a very high percentage of the time. Now, The key is trading it though. All right. The key is, all right, it's not a foregone conclusion. As soon as I get in long or short, I'm going to be within that statistic. But we need to know how to trade it because there's other services out there and so forth that they offer statistics about fading the gap. All right. Now there's a big contingency of folks out there that say, every gap gets closed. Okay. And perhaps that's true over time, but not every gap every day gets closed. All right. And if you're just, of the contingency that, the market's up, I'm going to fade it because it's going to get closed. And that's a power gap. All right. With little or no retracement. Okay. You're going to be chasing your tail there the rest of the day. All right. But there are ways of determining whether or not a gap is more likely to get filled or not, but we need to understand the dynamics of the opening range. Okay, so this is kind of the stuff that we do here with our members, and again how we have learned to trade it. Now my background as a market maker, just to kind of regress for a moment, uh, we were part of the opening range sequence, right? So we were making markets every day. We're part of the closing range sequences, and we were making liquid markets. We were adding liquidity to the markets every day as market makers. Now, how I learned how to trade the opening range back in the day, it was basically taking the first 5 minutes for the S&P and first 5 minute opening range. So the first 5 minute bar, and then so you have the high, low, and the midpoint, right? The three cardinal points. And so as what we call the opening range rotation, so the market regulators allow a certain roughly 5 minutes before to execute all the opening orders. Unlike the market on close orders that we look at for every day, where everybody gets the exact same price. On the open cash opening, not every whether it's retail investor, trader, or institution is going to get the exact same price. All right. But as long as that price that they receive is within that 5 minute window, all right, the regulators deem that it's an acceptable price entry. Okay. So, but basically, we look at the first 5 minute high and low on the ES. On the Nasdaq, we're slightly different. We use a 3 minute. All right, and we'll go over that some of the examples today. All right, but that allows that opening range essentially is the first reference point of the RTH session, and it's very meaningful given the statistics that I've just cited up there. All right. So, some of the psychology aspect of it you can kind of read along with me there. But the idea is, when the opening range is looking for initial price direction, moving away from the opening range or will revert back. Okay. So there's, if it retraces back to the opening range average, that's that midpoint. All right. The market typically will try to support it on a strong opening on any retracement back to the midpoint. But if it doesn't and it reverses, then there's other things at work. But it's a very important time of the day, so everybody should be very aware of that. Okay. What we'll do now is that's just kind of giving you some of the background, looking at some of the gaps that occur. Okay, so there's a breakaway gap, or I kind of refer to that as a power gap. All right, where the market moves away from the prior day's range and doesn't make any real attempt to go back and fill that range. We were just talking about filling the gap. So this would have been a case where if somebody faded the gap to the long side on the image on the left, and there was no response. All right, they found themselves, on the backtracking quite a bit. You'll notice on the image on the left, and a lot of times what will happen here is prices move down, and then you'll get a retracement back to the opening. So you can see that retracement back to about that midpoint of that 5 minute range. That offers a secondary opportunity, all right, given other triggers that you may be using as an opportunity to establish all right, in this case on the left-hand side, a short position into that. Okay, so that's one way. But the part of the opening range that we will trade and we'll go over here is actually the breakout part of it, not necessarily the retracement part. Although that is part of an opening range sequence, but a lot of times, as you can see, that this time kind of went by a little bit, and it looked as though this was closer to about noon time when the retracement back to the mid open occurred. But for our purposes, we're going to be looking for a momentum move outside of the opening range uh, high-low for a momentum kind of push. All right. So that's an opening breakaway type gap. Right. Again, I refer to it as a power gap. The other one, which is the type of gap that, in my experience, tends to get filled, is when we have a opening gap. And of course, the equity market's pretty much open with some type of a gap every day, as you are well aware. All right. And so when the market opens with a type of gap that's inside a prior session's range, as you can see on the right hand side, so an inside gap, this is the type of gap that typically gets filled. All right. So we would be looking for potential for reversals back towards towards the gap for a gap fill close. Not necessarily immediately on the opening as we traded, but at some point, all right, as the dynamics of the day unfold. Now, so these are just two example gaps that you're definitely going to more common you're going to run into, and it's certainly good to be aware that you know many times breakaway gaps will not fill, all right, or take some time to fill, whereas the inside gaps are more prone to fill. Okay, so that's just a little background on gaps. Again, you can read the text there, all right, but we'll move on to what we want to do and cover today. All right, so in our world of opening range breakout strategy, okay, we're going to give you some practical step by step exactly how we uh, look at the opening range, what levels to trade from, and we're going to offer you some statistics that we have as well, all right, to back up why we are so strongly uh, excited about trading the opening every day. Okay. Now, again, it is not a you're going to have some losses, all right, and like everything, but with the type of statistics that we have uncovered, all right, it gives you a high level of confidence. So there's two trade sequences to our opening strategy. One is a primary direction. So if we have an opening gap to the downside, that would be considered the primary direction. All right, and then and then the next one is a reversal. If certain parameters do not get fulfilled on the opening, and then there's a high tendency for a reversal, not a gap close. It's different, but a reversal. And by playing that reversal, could potentially lead to a gap close if that's the type of day it is. But we're looking for a strong reversal. So here's our step-by-step approach to get in. All right. So the entry with first off with the NQ, it's the first 3 minutes. Just make a note. And with the S&P, it's the first 5 minutes. We're going to use particularly the NQ here for this presentation because the NQ, because they're much higher beta components, right, to that index, uh, there's a lot more juice to it, momentum, right, that happens on the opening versus the S&P. So these statistics here are specifically to the NQ, but you can correlate them similarly to the S&P, but you would need to, right, just for disclaimer purposes, you would need to definitely do your own research and data mining on the results of the ES. But these are specific to the NQ, and this is and the NQ is the one that we look at specifically. All right, so we look at a 3-minute chart or a 5-minute chart. All right, and 3 minutes going to be on the NQ. So with that, All right, the entry will be, so basically you establish the first 3 minutes high, low, and midpoint range. Okay. Now the entry is gonna be 2 ticks above or below the high, low of that range. That's the entry point. Your stop, the initial stop, all right, is gonna be the opposite side of the range, 2 ticks above the opposite side of the high, low range. All right. Now we'll talk about the idea of the width of the range, and we'll talk a little bit about risk management in a upcoming slide. The alternative stop, okay, will be above or below, 2 ticks above or below the midpoint. All right, the opening range midpoint. Remember, that's the first 50% point of the range. Okay, so that's the entry and stop loss parameters. Contract sizes and so forth, we'll talk about shortly. The first scale will be the target one. Okay, now the targets that we calculate are proprietary targets. They're not based upon Fibonacci's. All right, they are specific percentage targets. All right, that we hold close to us. All right, and just suffice it to say that the first target here, T1, historically has a 79% probability of getting filled. Okay, and the second scale, assuming 2 contracts or greater, would be has a 60% probability of getting filled. Okay. Now we also have target 3 and 4, but they are expansion targets, and they have, again, on a daily basis, they don't typically get filled that often. What we're looking for on the opening, remember, it's a high it's high momentum right on the opening. We're looking for that, first strong push, and we're looking to take, a high probability trade, all right, from that. So again, 79 and 60% scale 1 and scale 2. This is on the primary direction. Okay. Now some of the notes, and the notes are always important, right? So if you've ever looked at a financial statement, right, the note section is probably the most important section. But the note section here is, once target 1 is fulfilled, you can then use a trailing stop, move that to your break to the entry point. Okay. By doing so, that's going to increase your overall success rate. Okay. Now there will be at times when you do that, the price will retrace back to the entry and you will get stopped out. Okay. On your second unit. For us, that's acceptable. As long as, as soon as we get target 1 fulfilled, I'm moving my stop to entry. Okay. And even if I get stopped out, so be it. We just pulled some high probability trade out of the market, at the time. Okay. On the second note, once target 2 is fulfilled, the reversal play is invalidated. Okay. So once the first 2 targets are filled, the reversal play is invalidated. And of course, if price momentum is very strong, right, of course, risk management is at the trader's discretion. So that is the primary direction. Okay, now we're going to give you a little view of that, of what it actually looks like. Okay, so you can see here on the NQ, we have our opening 3-minute candle. All right, and the entry, in this case, the gap was to the upside. So the primary trade is going to be the long, all right, at the top part of the range. Okay, again, approximately 2 ticks. Now, with the NQ, you can get a significant amount of slippage. All right, and so just bear that in mind. But what we're shooting for is, roughly that 2 ticks above or below the range. All right, for the entry, and then the initial stop is going to be the opposite side of the range. Now, I'm not going to get ahead of myself about risk management at the moment. Just want to get the kind of the mechanics of this. All right. And by the way, speaking of mechanics, this is a very mechanical type trade. All right. You can do it manually, or you can use, we have an auto trader, all right, that will do it for you. Okay. If you're, all you have to do is simply enable it. It's just a one-click enabling, and you have your parameters and your risk management already predetermined, and position size. It will just automatically take it for you. Okay, so that's or you can do it manually. I mean, there will be times where doing it manually may actually offer you a better price point. Right. So remember, if you're doing something mechanical with an auto execution, it's going to follow the rules to the strict to the letter. And with obviously with being a discretionary traders, I think most of us are. I like to have computer assistance, but I want to have somewhat flexibility. All right, as well. So as you can see here with the entry, all right, again, assuming roughly 2 ticks or so above the opening high. The first target here uh, was fulfilled. Okay, then we got a pullback. Now notice, right, the pullback here, I pulled back to the high, which was our roughly our entry. Now again, I did not put, as I stated just moments ago, uh, typically when we get to our first entry target, okay, we can move our stop to entry. An alternative to that, which is not listed here, but an alternative to that would be move your stop up to the midpoint. Okay. Again, the idea is, if the read of the market action and the pace and the rhythms are such that you believe there's potentially higher targets that can be fulfilled at some point. Okay, the idea is we want to mitigate our risk, right? Everybody certainly wants to eliminate risk, magically, but we do want to mitigate our risk. So if we were risking, say, 10 handles to start off with, right, or 15 handles to start off with, and we're able to mitigate that by cutting that roughly in half, right, but staying with a continued position, all right, then again, how you adjust your stop ultimately is your choice. All right, we have kind of two recommendations here. One would bring it to entry, and another one would trail it back a little bit. And in a good spot to trail it back would be roughly the midpoint. And then as the market, starts moving higher, okay, and let's just say as this in this example, price did pull back and then it started moving higher back above the initial target one, then if you had your stop at the mid, you could then begin bringing it up to, these low pivots down here. Again, that's all at the trader's discretion, but, again, I can only offer some recommendations and based upon the statistics that we have, right, and the results. Typically, when we get to target one, we move our stop to entry. And if we get stopped out here, so be it. As a matter of fact, I'm going to show you an example, a live example from, it was either yesterday or the day before, where this scenario actually happened, where I took out target one, stopped me out at entry, I re-entered, and I ended up getting a second trade out of it. All right, so that's the primary trade. Okay, now we're going to talk about the reversal for a moment. Right? And again, these are specifics. You can use these right out of the gate. You can, we would obviously recommend, if you're going to trade something like this, do it in simulation mode for a bit. All right, and so you have, you have an understanding of the mechanics of it. All right, so again, very similar to the primary, but some of the conditions will be different. So again, the entry will be the same, 2 ticks above the higher low of the range. The stop loss, all right, again, to the opposite side of the range, 2 ticks. The alternative again will be at the midpoint, as in the primary example, right? So that hasn't changed. All right, so that mechanics is exactly the same. All right, the statistics for this though, all right, are actually better than the primary, and this is based on about almost 2 years worth of data. All right, live data trades that we've taken. All right, so the first scale, target one, this is on the reversal, has an 83% probability. Right, the first one I believe I had mentioned was 79%. On the primary, this is 83%. And on the second scale, target two, all right, 76% probability when price reverses. Okay, now and that would be versus 60% for the primary. So the notes here are really critical to understand, and it may take some time for the trader to absorb the different scenarios. All right, but if the primary entry is triggered and T1 target one is fulfilled and then stopped out on the balance, okay, the reversal play is validated. It's in play, potential. We don't know if it's going to happen, but it's on the table as a potential reversal play, right? So if target one, this is on the primary now, primary move, target one's hit, it's fulfilled, right? You sell part of your position, you move your stop up to even, let's just say your entry point, and then you get stopped out on that, all right? And it doesn't go up any further. It starts reversing back down into the opening zone, right? The reversal play at the opposite side of the range is in play, is validated. If the primary trigger is not filled, so you triggered in on the primary, just as in that first example, but you don't get to target one, all right? Remember, your stop is either going to be, all right, at the opposite side of the range, or as an alternative stop, the midpoint of the range. Again, that's going to be your choice on how to manage your overall risk parameters on that, right? So it may be beneficial to at most times to have your stop around the midpoint. We've been actually doing some back testing on that, and that actually has improved results dramatically. Okay, so we'll go over some of the stats there momentarily. All right. So again, if the primary is triggered but not filled on T1 and you're stopped out, again, the reversal is in play. And then lastly, this note is if the primary is triggered and that's fulfilled, but target two is not fulfilled, and this is important here because a lot of times you'll hit target one and it'll kind of zoom up to near target two, but just doesn't get there. And then it comes all the way back down again. At some point, you'll get stopped out, of course, all right, depending upon your management. And then the reversal play is again on the table, all right. So again, you'll have a you'll be able to have this on your desktop if you want. And again, it does take a little bit of time to assimilate the variety of opportunities that you have here. But again, these are based upon statistical back testing and forward testing, all right, and testing every day, constant data mining of everything on a daily basis. And these are the parameters that we have come up with. Are they the best parameters? These are the best parameters we have found so far with the NQ. But we're constantly working to refine what we're doing here, right, as the market conditions change, right? When we had very high volatility not too long ago, okay, again, being able to adjust your risk parameters is critical. We want you to get at least 2 contracts on 2 units, all right? So a unit could be 1 contract or greater, but we want you to get 2 units on or more. But if the risk per unit far exceeds your personal parameters, then you may need to opt to pass on an opening range strategy. As of late, the volatility has contracted. Actually, has offered us some very good opportunities for multiple contracts with the opening range.
Thanks a lot, Danny. Can you guys hear me?
Okay. So let's get to the next slide. Let's see what we have in store for us. Okay, so this is a snapshot of the opening range reversal trade.
Get the other room.
So in this case, we have a gap down.
Okay, great, guys.
Okay, and you'll see that the entry, I didn't actually mark it here, but the entry would have been 2 ticks below the low, reached target one. Okay, and so your stop would, again, your initial stop would be at the top part of the range. Now your stop could have been moved to your entry as stated earlier, or the mid, right? And that's what we really recommend. Once you get to that first target one, okay, we really don't want you to have your stop sitting, at the opposite side of the range. We want you to, manage your risk accordingly, because if you kind of take a look at this, all right, if you got target one and then you waited and you had your stop all the way back above the opposite side of the range. Now that's visually here, all right. I mean, that's not a good, 2-to-1 reward risk ratio. You can kind of see that it's almost like 1-to-2. So we want to get you. Remember, it's a momentum play first. Okay, so we're trying to get that quick push to a high probability target, and then manage the risk accordingly. But you can see here the target two did not get filled, so hence the reversal was in place. So the re-entry, assuming, take your first profit at target one and you got stopped out, assuming, you know either entry or midpoint as recommended, your re-entry on the long, okay, would be through the opposite side of the 3-minute opening range in the case of NQ. Now, keep in mind, if you take a look at those statistics back there, very high percentages to get the target one and get the target two on a reversal. So as you can see here, all right, very clearly it fulfilled in both cases. Okay, so those are the core two scenarios of our opening range strategy. All right, and again, this is a workspace that we have, all right, for Sierra Chart, and the targets are already pre-calculated, predetermined for you. All right. Again, we don't give out the details of the targets, but the targets are uh, calculated based upon um, lots of testing on which targets most likely get filled. All right, in various scenarios. Okay. So that's the reversal. Let's move on. Position sizing and risk management. All right. Now, a lot of folks have difficulty with position sizing. I've seen traders, particularly retail traders, they're going to risk $200 on one trade, and then all of a sudden, they're blossoming and they risk, $1,000 or so on another because they move their stops and all that, right? That is really bad practice. All right, that is just, I mean, again, it's position sizing is so important. I mean, and many traders are single lot traders, and you have to really, no matter whether you're a single lot trader, 2 lot or a 200 lot, it doesn't really matter. That's just a matter of account, equity size. All right, what you have available. All right, but in all cases, all right, you have to manage your risk so strict. And when I say strict, I mean you have to have a uniform type of risk management available to you, that you're going to risk X amount of dollars on every trade. Now, again, we want to mitigate that and reduce it, but you don't want to let that, if you're going to risk $200 on a trade or $500 on a trade, right? You cannot go, oh, I'm going to move my stop a little bit, and now I'm going to risk $800, because sure as I'm talking here, you're going to get stopped out on that $800, and you just gave away $300 for no reason. That's what I call an unforced error. All right, these are things that traders can control, and one of the things you can control is two things, actually. You can control the type of trade setups that you want to enter on, and they should be based upon not just throwing, an idea up against the wall and seeing if it sticks, right? You know what I'm talking about. But rather, your trade selection should be based upon historical statistics, knowing that, you know that they work, okay, to at least a certain degree, and they're acceptable. And then you can control the risk. How many contracts, uh, what's your dollar risk on it, and then your contract size, your position size is actually a function simply of your entry price and your stop, right? Given a certain specific dollar risk, all right. So of course, the opening range strategy here, it is very powerful to our toolbox. obviously has its own unique risks. It is a momentum play, and momentum can reverse pretty quickly, at times, right? Particularly in the high volatile times. But again, you got to be prepared. You got to know exactly, what you're going to do in various market conditions. And I noted here, just as a reminder, kind of think fire drill, right? We were all brought up, whether you're in school or you're at home or your families now. I mean, does anybody have a fire drill plan in their homes? If you don't, you really should. All right, no matter where you are. My next door neighbor, all right, just had a fire about a week ago in their house, and it made my wife and I, for our family, think about what our own fire drill was. So that's fresh in my mind, and that's why I put it up there. But again, you got to be prepared, right? The market conditions are going to be very dynamic, as we all know, particularly with the NQ where it's very volatile. You got to know what you need to do out of the gate. Now, you can't do that on the fly and say, okay, this is what I'm going to do. You have to, and I think this is what I'm going to do. You need to have that a plan already. You need to know, what your maximum risk parameters are, right, in advance. What's the position size going to be based upon a given range, all right, of the opening. Okay. In the NQ, since it's $20 a point, right? What are you going to do if it's a 10 handle range? Right? That's $200 per contract, right? What are you going to do if it's a 25 handle range, which we've had at times? All right. Now, again, you have to decide, well, how much do I want to risk per trade sequence, but also per contract? So remember, so in the examples here, and just prior to this, what's really important is I think I've already alluded to, your risk has to be uniform. Right? You just can't risk 200 on one and then let it slide and go 800 on another, because it's going to be, your comparisons of any statistics are going to be all over the place. And not only that is you're not going to really reap get the confidence that you really need, because if I lose on a single contract, but I know my position size can be 4 or 5 or 6, and I start off on a probe, right, with 1 or perhaps 2, then if I lose on that 1 or 2, okay, at least I've lost on 1 or 2. It's smaller loss, well within my maximum risk parameter, and then I can live to trade another sequence, right? But if you're all over the place, which many traders are, all right, again, you're going to, first of all, you're not going to have any confidence in the method whatsoever, because you're not going to be able to allow the method to play out. And you will have losses with this method, there's no question. But given the probabilities of successes that we have shown, and that's close to a 2-year history, there's a lot of advantage to doing it here, but you need to keep your risk uniform. So quickly, a couple examples, right? So let's just say you're risking $500 per contract. All right, the opening range is 25 points. All right, so your max position size is 1 contract. Very simple. Everybody should be able to do that math. If it's half that, or 12.5 point range, I think today was roughly 13, if I'm not mistaken, 13 and a half. And so, now you can double your max, double your position size, given the same amount of risk, $500 risk. Okay. So, again, you need to kind of figure that out for yourself. All right. What if scenario? What's your primary, maximum risk? Right. And here's a note, right? Be sure to consider what if primary stop out scenarios. So let's just say, the first one was, you're willing to risk $500. So you take the primary trade in the direction, but that gets stopped out. Now you got to say, well, are you willing to risk another 500 for the reversal play? All right. I can't answer that question, but that is something for you. That is something that you need to determine. Okay. And again, we knowing at least our historical statistics, that the reversals are very strong. Okay. You got to be willing. Well, I lost 500. Do I want to lose? First thing everybody thinks of is, oh, do I want to lose another 500? Again, how do you know you're going to lose another 500? Particularly when we have a strong, statistics on reversals. Point is here is you need to be prepared in advance. Okay. And again, the risk must remain uniform. Otherwise, the statistics, that we're going to cite all falls apart and so forth. So speaking of statistics, all right, we're going to give you some statistics here from one of our members. All right, Dan V. He has been a long time Polaris Trading Group member, and he is a very mechanical trader. This is his primary. When he was introduced to the opening range strategy when he first started, again, this was something that really piqued his attention, and he went all in, working with it in simulation mode for quite some time. Okay, massaging what works best, right? Adjusting some of the parameters and so forth. So it's important for me to state, though, all right, as a disclaimer, that Dan makes no claims or inferences that his results can be duplicated, and he's graciously offered his opening range trade statistical summaries here for educational purposes only, and so that other traders may find some beneficial edge, all right, to their own trading. So we appreciate Dan's contribution here. So looking at the statistics now, I've already cited them separately, but we'll just take another look at them. So this is the breakdown of the NQ live tracking since 2017. And again, the initial trade direction, which is our primary direction, right? We have a 79% probability that once entered in primary direction, as stated in how we do it, 79% success rate, right? Um, and then a 60% reaching target 2. Now there are targets 3 and 4, but we're not going to really cite those because the probabilities go way down. And again, remember, this is a momentum type trade. We're looking for that, quick target 1, target 2, all right, if the market offers it to us. And you can see the reversal trade, right, has, again, an 83% chance, all right. This is when it doesn't reach target 2 on the primary and it goes and reverses back up or down. Target 1 has an 83% winning rate and a 76%. So again, in both of these instances, they're fairly high, and these are actual live tracking every day since I'm not exactly sure what month in 2017, but at least a year and a half worth of data to this point. And so those statistics, all right, are Dan's specifically, okay, and I concur with those historically. And so taking these statistics along with the earlier stats that I cited from Larry Pesavento, that 85 to 90% of the time, based upon his work years back, that the opening range or the opening price is going to be within 10% of the high low a very high percentage of the time. So you can see, so we got some pretty strong statistics to back up why we like the opening range breakout strategy. Okay. There's some other notes here that that Dan wanted me to cite. They're not shown on the slide there, but during this period, the initial direction, okay, the longest winning streak. So a lot of people say, and again, this is an important factor, right? How many winners in a row? How many losers in a row? All right. So it's really important to understand, it's great to see, to cite these stats, but how many losers have we had in a row? How many winners do you have in a row? All right. So, so we need to, consider that. So what Dan has also found from his work, that the longest winning sequence on the primary initial direction all right, has been 13. That's the longest. And the longest losing sequence has only been 4. So 4 in a row. All right. And again, these are sequential losses in a row or wins in a row. Okay. So then they'll vary, right? You'll have 2 winners, 1 loser, 3 winners, so we're talking about the longest winning and longest losing. So that's 13-4. On the reversal direction, longest winning on the reversal is 16, a little bit better, and still better on the losing, only 2. So again, given the higher success rate on the reversal, we also have solid winning streaks versus the losing streaks. Again, this is hard data that I am on. The slide that I'm on is the opening range breakout strategy statistics. I see that it is being shown properly on the other computer. That's the slide I'm on. I only have, I think, one more slide. Okay. Okay. You think you're all set? Okay. Great. All right. And then the last slide here, right, kind of brings us right into the close. Again, same disclaimer that Dan, his results. Now, this is the alternate midpoint strategy. So this slide here, the first one that I showed you, this is based upon you put your entry at the one side of the opening range, and your stop is all the way to the other side of the opening range. Okay, no matter how wide that range is, as long as you're within your risk parameter on at least one contract. This one here, this slide and the statistics, this is the alternate midpoint stop statistics. Okay, so essentially same entry, but now you're using a midpoint as your stop point versus the opposite side. Now, these are statistics that Dan has recently generated, okay, with that scenario. And again, what will happen here is you'll see that the percentages of winners slightly goes down on the initial, okay, 69 and 49 to target 1 and target 2. And then on the reversal, again, slightly lower percentage, okay, but, all right, the key is your stop point now is halfway, all right, it's midpoint. And so it's really important to understand, right, for, instead of risking, when you're getting a 1-to-1, you're actually getting a higher risk reward or effectively expectancy. Okay, you're getting a higher expectancy, even though we have slightly worsening, key statistics on it. But actually, your overall results actually improve, and then your break-even point, right, is actually smaller. Okay, so you have an opportunity that if you do get a runner, that you'll be able to carry that. Okay. All right. All right. I am doing my audio, Marlon, from the workshop room, I believe. I think, does everybody hear me okay? I hope so. Or we'll have to do it again, which I don't mind doing. Okay. All right. So, so that is our presentation on the opening range. And again, you can certainly contact me if you have any information about that. Here's what I want to offer you. One last thing, though. This is the formal end of the presentation, and I'll certainly take questions if anybody has them. But let me show you some of the actual trades that we had taken this week. Okay, everybody should be able to see this chart. Now, this is a live chart that we have. All right, this is the workspace that you'll get with Sierra Chart, and also I believe with NinjaTrader. Yep. All right, but these are the actual trades that I took live in front of everybody. Right, we're live, not Memorex here, and again, very tight here, but you may be able to see it slightly. But again, the entries were approximately, this was the primary direction up. We took that primary trade to target one. This was the one over here to the left where I got stopped out. All right, so I moved my stop. So my stop was originally down here below, and then I moved my stop to roughly break even or break even plus one or somewhere right around there. And then I got stopped out, and then I looked at it and I said, you know what? I want that trade back. Okay, so I took that trade back, and I ended up getting target one again. All right, and then target two. All right, so just because you got stopped out on one doesn't mean you can't go back in if the conditions, warrant, and they did. That was that was yesterday. That was yesterday morning. Okay, the 20th. So that was our opening range sequence there. All right, and you can see what happened later in the day. Technically, the reversal is off the table once target two gets fulfilled. All right. So as the morning unfolded, there was really no other play in terms of the opening. But I will say this. All right. You want to keep that opening range really in mind, because later on here, you notice what happened was the market weakened down and then did break through the opening range low. Okay. In effect, again, and this is in hindsight, but in effect, there was a potential, right, to go lower on the reverse, because the market actually did reverse, right? But for different, not opening range reasons, but nonetheless, you could see that the key zone. Remember, the key zone will always be that opening range throughout the day. It's very important. Okay, because everybody benchmarks themselves off the opening. Now, everybody's always concerned about the VWAP, which is important, but that opening range is ultimately key, all right, as the day unfolds. So if that opening range failed, like it did later during, I think during lunchtime yesterday, you can see now these two target zones down here. That's target 3 and target 4. So we got the reversal in play. All right. And the first two targets are the high probability ones, but because it happened somewhat midday, there was a lot of trapped folks up there and a lot of energy to the downside. As you can see here, prices came back down. And just by note, if you look left here, notice where the 19th opening range was. So prices a lot of times go back to the prior opening and tests that as well, the opening range. All right. So again, people are familiar with that, right? Closing the gap to the prior close and, things of that nature. All right. So that's what happened here. And then today we had weakness. Wasn't really a strong gap, but we did clearly have weakness this morning. And again, I took an aggressive trade, coming off the mid here. All right. And again, the core statistics is take the trade from break of the low, but you have discretion to do, to get in earlier. But again, you can see target one and target two got filled. All right, and then of course these are the higher probability. Now this is the case today, where with a strong, pretty strong momentum, if you had multiple units. And you got target one, target two, and you still had some multiple units, this would be a case where you could just, hold on to a runner, okay? Because really, and look what happened here, right down to target 3 and target 4 before, today, where it found some support and then has rallied back since, okay? So again, the parameters that we have, the targets are very well back tested for many years. And again, recent statistics since 2017. This is just our opening trade every day, okay? And again, these were live over the past 2 days for the open house. We will continue to do these every day in our trading room, and this is how we do it. All right, so this is real world trading live, giving you all the parameters. There's no theory to this, right? No theoretical, this is all live, never Memorex. So that concludes my presentation here, and I'm right about at the 60-minute mark. So if there's any questions, I'll be happy to field some questions. Otherwise, we'll stop it there. I can. All right. And so again, if anybody wants to email me, ask me some questions, or just get in touch with whatever you need. All right. Feel free. Those are my contact information. Oh, there's no rush. Okay. Well, if anybody wants to have any questions, um, so. Dave, might it be smart to use the alternative on the first trade and the regular on the second? Yeah, you could use both. I mean, you could design it how you want. I think a lot of that has to do with kind of what the pace and rhythm is of the opening. Okay. Yes, Barbara, it will be recorded, and we'll have it. It is being recorded. We'll have it uploaded onto the website. All right. I think yeah, Marlon's recording it as well. So dual recordings. So yeah, so you could use the alternative for the first trade. Ideally, it's all really going to be based upon your personal risk parameter approach. All right. If you take a look here, one of the things we use, all right, is on our chart. Okay, what we do here is I have a bar difference settings. All right, so I'm going to unhide that, and you'll see, right, every bar. Let me see if I can zoom in here a little bit, see what today's opening was. All right, so you can see today's opening was 13. All right, 13 range, high to low. Okay, so what you want to do is you want to determine for yourself, what would you do? How many, what's your risk, dollar risk per trade or per trade sequence? All right, are you willing to accept? Okay, so again, we ideally, these are examples with 2 contracts, just for demonstration purposes. But I mean, if again, if you have a higher risk tolerance, and you want to trade more, that's great. But again, you always want to know what the range is, and then you certainly could put your stop, after trigger in. The problem with putting your stop too fast is, like, all of us have issues. If you put your stop too fast, okay, you run the risk of getting stopped out prematurely. All right, so you have to be willing to accept some level of risk to the opposite side. So the idea is, plan your position size or risk parameter based upon various scenarios, right, as was stated in one of the slides as a suggestion. So how many contracts, think about it, how many contracts would you be able to trade with 13-point risk? Okay, well, how much are you willing to risk per trade then, right? Whether it's 1 contract or 2 contracts or more, per trade sequence, what's your maximum risk that you're willing to accept? You have to start there. Once you start there, then when you when you enter the trade, okay, you stops here. Let me just use a marker here. Okay, so it kind of explain this a little bit. All right, so if you enter the trade here, down here, you got to be willing to accept the risk to the opposite side. Okay, does that make initial sense? That's the planning of how much you're willing to risk. Now, at some point, as the prices moved lower, then you want to then perhaps you're asking the question, can you move your stop here, or can you place your initial stop at the mid, right? You can, but again, I'm gonna just say that particularly with the NQ, right? If you did that over here, I mean, you're gonna get stopped out in a heartbeat. All right, because the way the opening is pretty volatile. So my recommendation, as a suggestion, right, would be calculate your risk per contract at various range parameters. Put your stop at the original range parameter, okay, and that would be, hey, that's my max risk, all right, per contract. But if I have the opportunity as prices go, a touch lower, all right, nearing to that target level, okay, then I'm going to bring my, I'm going to move my actively have active stop management, right? I'm going to move it to the mid, or in many cases, what we like to also say is if you're getting, within a point or so of that first target, okay, remember, you're your own risk manager, all right? So if you're within a point of that first target, and you had your original stop, up above here, and then you decided, as it's moving, as it's starting to move in your direction, okay, I'm going to move it to the mid. If you're within a point or so of that first target, guess what? What we suggest, move it to your entry. I'd rather stop out at my entry. If you want to cover commissions, that's fine. But I'd rather stop out at my entry, on a quick snap back up and stop me out of the trade, all right, than have it too loose and then have it, I could then you say to yourself, well, I could have stopped out even, all right, and I didn't. There's a fine line there. I'm not saying which is right or wrong. What I'm saying is a technique, all right? At what point are we all at maximum risk? At what point? Does anybody know? Everybody should know. When you first enter the trade, there you go. That's when you're at maximum risk. So if I'm at maximum risk, I'm willing to risk my maximum amount, and that would be to the opposite side of the range. Okay, that's my planning risk. All right, my MAR, my maximum allowable risk. But as the trade hopefully progresses in our direction, you can then actively mitigate that risk by adjusting it down. But if you put it too close to the question, can you put your stop at the mid like immediately? You may find that is you may find yourself getting stopped out prematurely. All right. And I understand what the reason would be. I want to lower my risk as much as possible, but you really want to be able to mitigate it as it's going in your direction, because there will be times when the market will flip back and forth very violently on the opening. All right. And, you want to be able to you want to stay out of the noise. That's the idea about where your risk should be, is outside the noise field, right? So anything, inside the range itself is noise. Once you start moving outside the range, all right, isn't really noise anymore. It's expansion, or it's direction, it's the momentum, right? Then you can think about, actively moving your stop. Does that make sense? Again, it's a suggestion, all right? Everybody needs to, that's why the whole idea is you need to decide what you're gonna do in advance under certain scenarios, okay? Michael asks, does this require the opening gap? If so, how much of one? No, the opening range strategy, Mike, is regardless of whether there's a gap opening or not, if that's what your question is regarding, whether it's a large gap or not. We've traded it when it's a relatively narrow gap. Yeah, we've traded it relatively narrow gap. Like today here was not really much of a gap. Okay, if you take a look, all right, really wasn't much of a gap to the close. All right, I mean it's slight, but I mean not comparative to the other day. All right, I think the other day was well, actually this one wasn't much of a gap either. All right, so it was more, but you'll see, yeah, here's a pretty good gap here. Okay, here's a pretty good gap. Now here's a case where you know, and I think this was coming off the holiday, so this was somewhat of a special situation because of the way the holiday was. But we had the big gap down, and then we got the strong reversal, okay, off the gap. I actually missed this entry. That's why you don't see one there. I actually missed this entry, but this was kind of a holiday situation. But no, you don't need to have a wide gap. All right, we'll trade it every day. Okay. Um, but what will happen is typically when the wider the gap, all right, let's just say there's more pent up energy for a stronger directional move in either direction. Okay. All right. So when we have a narrow gap and we're kind of within the range of the prior day, we'll still play it. But again, you just may not get that thrust that we're looking for. All right. So, and you may have to, like, for instance, my first entry over here, on this day, I carried a little heat. Right. I entered it and it came back down to the mid. By the way, the mid can also, and again, this is like an alternative. The midpoint can also be used as an entry point. I did not present that here. All right, but as an alternative entry, if you didn't take it immediately off the opening high in this case, you could have viewed the midpoint as an entry point, and then your stop would go at the same level, would be the opposite side. So that is an alternative, but that wasn't really discussed with this particular uh, strategy the way we have it. Um, Next question I have, it shows, let's see, if in the first example, I guess you're assuming this one, Hetty. All right. From 2 days ago, okay, target one was hit and then target two wasn't when you got stopped out. What made you decide that it was continuation of the primary and not a reversal trade? Okay, good question. Again, I think it has to do with pace and rhythm. All right, so the question effectively is, why did I go back in? Okay, instead of waiting for a reversal, right? Remember, the reversal would not occur until down here, okay, to the lower part of the range. So when I got stopped out here, all right, and as you can see, I got stopped out and prices, let me see if I can use the cursor. The prices here on this candle after I got stopped out, it looked like a pretty good stop out. I was not disappointed with the stop out. Um, and then it came all the way down here, right? Well, I was prepared to play the reversal. I believe I had a standing order at the time. I was prepared to play that reversal, but the midpoint actually held, and you can see that there's a little bit of a hammer candle there. And then when I saw that hammer candle, okay, my assessment of the pace, of the rhythm, of what's happening at the time, that it's more likely wanting to maybe try to have another attempt higher. Okay. Again, very active analysis, very active of what we're doing. All right. Um, and then I said, you know what? I said to myself, I want that trade back. Okay. So I want that contract back. So what I was willing to do, and again, goes back to the slide where I was saying, if you get stopped out, are you willing to go take the next trade out of it? Right. So I was willing to take the next trade here and simply, all right, and simply went back in, okay, and then used the same, parameters of the opening to take that next trade. Now, of course, I run the risk of, it not going and then coming back down and getting stopped out naturally. But again, that's the idea. Am I willing to accept that, trade? Well, I had a little bit of profit in it. So even if I went that route, I probably didn't have, my max risk anyways at some point. So that becomes an active decision, all right, for you individually. And I think ultimately, experience using this method, this technique, all right, working with it, specifically in simulation mode, in the early days, learning it, getting a sense of how you would want to trade various scenarios, is really kind of key to this whole thing. All right, so that's just something that kind of comes with time and kind of being with us on a day-to-day basis. All right. Do you have stats on how your opening trade did last year? Winners, percentage winners, and gain or loss. You would need to talk to Dan directly about his specifics. I've only offered you, what we have here. I'm sure Dan does. I don't know what they are. So that would be something if you wanted to, if he's willing to talk to you directly about that, you can perhaps contact him if you want. Um, do you have better results if the opening if the open is outside the prior day range? Now, I don't know if again, these stats come directly from Dan. I don't know if he's data mined what occurrences happened when, what were the results for only the occurrences that happened when it was a gap outside the prior range. Is that what you're asking, PA? All right, I think that's what you're asking. All right, so I'm not sure how many occurrences he had on that, or if he was tracking that. Again, you can go down the rabbit hole. Let me just say, all right, you can really go down the rabbit hole of trying to data mine, all these questions. All right, and that's what data miners do, and that's where they get stats. But you know, but yeah, again, you would have to discuss that with him. Let me see if there's one final question. If there, Michael asks, if there is an open gap, okay, but the first candle goes in the opposite direction, which move do you go with? The direction of the gap or the first candle? So if you're using like a candle analysis, whether it's a hammer candle or one of those type of things, or an engulfing candle, I guess you're adding something in that I don't think is part of the statistics here. We're just basically taking that high-low range, okay, and then again, a lot of it has to do with remember we have that matrix bias grid, okay. So Mike follows up. All right, so clarifies a little bit. Gaps down. First candle goes from opening print up or the reverse. Let me see. So like this. So you had a strong gap down, okay, and the opening print was down. Actually, was down below here. Okay, this is a good example. All right. So okay. I have an idea what Mike's really get. So let's just say you get this one opened pretty much on its low, right? Yeah, and then it closed on at or near the high. That would be a condition certainly where you would want to go to the long side. Absolutely. All right. Let's just say you had, so in this case, I think that should answer that question. But let's just say you had a candle here. That's okay. You had a candle here where, it opened, say, the lower quartile, lower 25% of the final bar, right? It rallied up, all right, stalled, okay, didn't, get the opening high, right, but didn't trigger through it yet, and then reversed back down, okay, and then actually was lower than where it opened.